Important takeaways from How to Trade in Stocks by Jesse Livermore. What to do and not to do when trading. Written by the most successful trader who ever lived, Jesse Livermore. The book, How to Trade in Stocks, is a timeless compilation of practical trading advice, market analysis, money management systems, and emotional control guidance. In this video, we have gathered the most important takeaways from the book, presented in the author's own words. Please subscribe to our channel and like this video if you find it useful. We thank you kindly. We will also leave a link in the description below where you can listen to the audio version of the book for free. Successful traders always follow the line of least resistance. Follow the trend. The trend is your friend. Always track two stocks in the same group. They always move together and confirm the movement of each other. That way, you have absolute confirmation about the trend. Never buy a stock on declines. Never short a stock on rallies. Just because a stock has fallen in price does not mean it won't go lower. Don't anticipate market moves with your hard-earned cash. Wait for the market to confirm your judgment. Don't look for the top and bottom. Understanding industry group is essential to successful trading. Examine the market, the industry group, the sister stocks, and the actual stock in one glance. Go with the market leader, the most powerful stock in the group. Don't look for the bargain, the weaker sister. Don't have an interest in too many stocks at once. It's much easier to watch a few than many. Follow the leaders on the market. Establish a profit target, risk-reward ratio, before you enter a trade. Decide on the potential of the trade versus the size of the investment. If it's a large investment with a small potential return, then pass. If you want to buy 500 shares of stock, start by buying 100 shares. Then, if the market advances, buy another 100 shares as a probe to see if your judgment is correct, and so on. But each succeeding purchase must be made at a higher price than the previous one. Avoid averaging down. Set a firm stop before making a trade and never sustain a loss more than 10% of invested capital. Take your loss quickly and get out if you lose more than 10% on a trade. Have two stops in mind when you enter a trade, a price stop and a time stop. Don't stay with any trade more than a few points against you, or more than a few days if the stock does not perform as expected. A change in volume is an alert signal. It almost always means there is something afoot, a change, a difference. Don't chase a stock if it gets away from you. Let it go. I would rather wait and pay more after the stock has regrouped and I receive confirmation that the stock will most likely continue its move. There is a never-ending stream of opportunity in the stock market, and if you miss a good opportunity, wait a little while. Be patient, and another one will come along. Don't reach for a trade. All conditions for a good trade must be on your side. Market direction, group direction, sister stock direction, and the timing must be in place. Remember, you don't have to be in the market all the time. It's not the thinking that makes money, it's the sitting and waiting that makes money. Patience, patience, patience. Wait for the right moment and have the cash ready. Don't try to figure out why something is happening. Let the market give you the clues. The movement of the stock is empirical evidence. The reasons will be revealed later when the chance to make money is gone. The market always precedes economic news. It does not react to economic news. The market lives and operates in future time. It is therefore foolish to try to anticipate the movement of the market based on current economic news and current events. The market has already factored in those events. Acquire a fundamental knowledge of economics and thoroughly familiarize yourself with conditions of each sort: the financial position of a company, its past history, production capabilities, the state of the industry in which the company is engaged, the overall economic situation. All tips are dangerous. Take no tips. When the margin call reaches you, close your account. Never meet a margin call. You are on the wrong side of the market. Why send good money after bad? Don't lose money. Don't lose your stake. Don't lose your line. A speculator without cash is like a store owner without inventory. Cash is your inventory, your lifeline, your best friend. Without it, you are out of business. Cut your losses, let your profits run. As long as the stock market is acting right, do not be in a hurry to take a profit. If there is nothing basically negative, let it ride. Have the courage of your convictions. Stay with it. It's the market's money. If you lose all this profit, well, then you have lost money you never had in the first place. Always have a method of speculating, a plan of attack. And always stick to your plan. Do not constantly change it. Find a method that works emotionally and intellectually for you and stick with it. Have your own customized rules. Once a trade has been entered, the trader must assume the status of an automation, a robot, and he must follow his rules. Always be aware of your emotions. Don't get too confident over your wins or too despondent over your losses. You must achieve poise, a balance in your actions. Cultivate poise, patience, and silence. Poise. Handle hopes and fears in a calmer manner. Silence. Keep your victories and failures to yourself. Greed, fear, and hope distort reason and cloud facts. The stock market only deals in facts. Thank you for watching, and if you find this video helpful, please share it with us in the comment section below. We appreciate your feedback. Tell us in the comments, what is your favorite book? Can't get enough of reading? Find us on Facebook at facebook.com/readandgrow1 and also on Twitter at twitter.com/readandgrow1.